Hey, good afternoon, everyone. I'm filming this on Saturday afternoon, March 11th of 2023. I absolutely hate having to make a video like this, but for those of you that have been watching, last week, a bank by the name of Silvergate collapsed. They were tightly tied in with the crypto industry, and after the FTX collapse, they ran out of liquidity, basically. There was so many redemptions that they couldn't stay in business, and they're now being forced to shut down because of the amount of people wanting to take their money out. They went from like 20 some billion in assets down to like 4 billion in assets and just couldn't continue. Most people thought, well, hopefully this is an isolated incident. Well, I believe that was Wednesday when Silvergate went down. Then on Thursday, word came out from the Silicon Valley that the Silicon Valley Bank was basically illiquid, wouldn't be able to honor their depositors' withdrawals, and the FDIC on Friday went in and took them over. Now, the big deal about this is that the Silicon Valley Bank, some people refer to it as SVB, is actually a fairly large bank. I don't know what number in the country it is, but it is a fairly large bank. As the name implies, it does a lot of business up in Northern California, around the San Francisco area. Deals with a lot of startups, and for all practical purposes, was a very, very well run bank. They invested in quality products. Unfortunately, they invested in such safe products that once interest rates started to rise, once the Fed started to rise interest rates, those safe investments lost value. They lost somewhere between 50 and 70% of their value because the interest rate was so low on those. There just was no market for them anymore. Even though the paper was good, they're like 30-year bonds paying like 2 to 4% interest. Well, now you can get a 2-year bond secured by the government paying 5%. So the whole value of those got completely twisted upside down. And on Friday, the FDIC did step in and take over this bank. Now, having said that, the people who have their money deposited in this bank will not lose. The FDIC will go in there. They're very competent at what they do, and they will almost ensure that most depositors will get all of their money back. The people that are going to be out are the people who own the bank, the investors in the bank, the creditors to the bank. Those are the people that are gonna lose out on this, unless someone was gonna come in and buy this thing out, which at this point, even if someone does buy it out, it's gonna be for pennies on the dollar. So, like I said, the depositors themselves are not gonna lose money, but it's gonna take a while probably for them to get their money, because anytime the federal government is involved, they have to verify that the people are authorized to get the money, etc. Here's where the rub comes. This bank deals with a lot of fintech, startup companies, high-tech companies, okay? One of which is Etsy, ETSY. You're probably all familiar with it. It's a marketplace much like eBay, except this is for people who produce their own products. There's a lot of vintage products on there. It's a very popular market. You probably are aware of it. And individuals sell on that, much like on eBay. It's not a huge... The company itself doesn't sell the product. They're a platform where people come and they buy from sellers all over the country, maybe even the world. I don't know if it's worldwide, but in the United States, it's very popular. And then they process the payments, and then they distribute them on a periodic basis to the sellers. Well, if you look at this headline, Etsy is warning sellers that there will be a delay in processing their payments due to this failure of the Silicon Valley Bank. Now, I know there's other businesses out there that are also in trouble due to this. For instance, there's a lot of companies that their payroll, for instance, was saved in this bank. Well, come Friday or whenever their payroll is due, they're not going to have access to that money to pay their employees. So a lot of these startups can't just go into other banks and get loans or get the money because when you're in a startup phase, cash is very short and you can't just go and find it anywhere. So I didn't think that there was going to be a problem in the financial industry, at least not yet, at least not until the real estate market collapses, which it looks like the Fed is determined to drive that into the ground as well. But last week we have SI, Silvergate International, not the biggest bank in the world. Now you have this bank, which is a pretty big bank, and was actually very well run bank. It wasn't like they were making bad loans and doing all kinds of stuff that forced this. It was they may have mismanaged their investments once the Fed started to raise their rates, but other than that, it was a very well run bank. Now we're hearing a lot of rumblings that this is not going to be the last bank. Some of the names I've heard is First Republic Bank. What we're seeing is apparently these banks have to release periodic statements, and a lot of people, short sellers on Wall Street, have apparently been analyzing some of these banks' balance sheets and identified the top ones that whose investment portfolio may be in the same situation as a Silicon Valley Bank, and these short sellers have been shorting these banks, which is going to add even more pressure to them because their stock will be of such low value that they can't use that for investment. And this may start a chain of events. I watched a great video by an expert last night by the name of Chris Wallen, who is an expert in this industry, and he calls this a contagion, or a contagion rather, almost like a virus. And once it gets in and starts working its way, these banks are all interconnected in different ways. They borrow from each other, they lend to each other. They're all intertwined, and so it's almost like when one gets pushed over, it can have a domino effect throughout the industry. And it may start with the small banks, but that these bigger banks usually have exposure as well. And this is how it can go very fast. And also the other thing is that they lost my chain of thought there for a second. Well, here, just look at this headline here. Etsy claims 7.5 million sellers worldwide, and most of those people are going to be affected by this withdrawal. I know what I was going to say is, what happens in this once the first domino or second domino starts to fall, Main Street media will pick up on this. They'll start blaring headlines, and you'll get what's called the classic bank run. Okay, this is where your average Joe, Mary, and Joe, thinking they're going to lose all their money, they run down to the bank and they withdraw all their money. Well, that's fine if only Mary and Joe do it, but now all of a sudden you got your whole neighborhood doing it, your whole city doing it, and it's a bank run. Banks don't, believe it or not, they don't keep a lot of cash. That's stupid. Why would you have all your cash? They've got it invested in other products. And so once these bank runs start, the failure becomes a what we call a self-fulfilling prophecy. It just accelerates at a rapid pace. I was on YouTube this morning, and I counted a number of videos with the bait-click headlines of "Go withdraw all your money from your bank right now," including huge YouTubers like Meet Kevin, Graham Stevens, a bunch of real estate investors. It is so dangerous to start that kind of talk. I'm not putting this out there by any means to be fear-mongering. I'm putting this out there that this is how the banking situation has ramifications throughout the financial world, and here we're seeing it. So SVB goes down, Silicon Valley Bank, okay? They go down. Now, Etsy, who has their money saved there, cannot pay their sellers. Well, those sellers, they have obligations to other people as well, either employees, people who they buy their products from, et cetera, et cetera. They have to pay their bills, they have to pay their mortgage, you know, and if they don't have their income coming in all of a sudden for an extended period of time, they have no place to go and get their money. So I really am not liking what I'm seeing here. The other thing I don't like is the Fed. Last week, Jerome Powell goes in front of Congress, banging his head on the table. We need more rate cuts. We need more rate cuts. They started way too late, and now they're going overboard. Now that the recession, the average person knows we've been in a recession for some time. It doesn't take a rocket scientist to figure this out, okay? Anybody that has inventory, their inventory is skyrocketing. People aren't spending like they were, at least on the frivolous items. They can barely make their car payment. They can barely make their house payment. And yet, here's Powell out there. We got to raise rates. We got to raise rates. We got to keep going. Then they're looking at employment data, okay, to base the economy on. They're saying, well, everybody's out there hiring. There was such a job shortage that COVID created that the country never picked up from. Our labor pool has decreased dramatically. There just aren't enough people to go around and to fill all the jobs. Everywhere you go, there's help wanted signs. And it's not because of wages, because the wages are great. So it's raising interest rates. Now we're going to start to see how it's going to have a dramatic effect on areas of our economy that they have to stop it. You know what I mean? Or go in there and make a statement saying, we know we have to get inflation under control. However, we have to either suspend interest rate hikes temporarily until we get our financial situation, our financial industry back on solid ground, and then we'll reevaluate at that time. And by that time, inflation will probably have caught up with itself. Gas prices were headed lower. Now, this last week, they took a little tip up, but gas had such an effect on why everything was driven up. And also our supply chain was so backed up that it took a while after COVID to absorb all of that. So the inflation was there, but then the Fed waited way too long, and now they've gone way overboard, and they're out there preaching to everybody that they got to keep going. These Fed governors, in my opinion, are so out of touch with reality and they're using antiquated methods. They're using methods that were developed back in the 40s, 50s, and 60s. Our economy is much different than it was back then. It's more international. It's more dynamic. It's antiquated, their methods of what they're using. And also, the Fed has a responsibility in all of this. One of their mandates is to keep our financial industry strong and working properly. Those of you that were around in 2008 know what the consequences are. And I hate to say it, but this is starting to look really, really like a repeat. And once the housing market collapses, they've already got it on the brink right now. Once that also goes, we're going to get a double whammy. We're going to get the real estate, and then we're going to get the financial industry. And it's going to be absolutely devastating. I'm not saying that real estate prices can't stand to come down. I think they can, and they should. But interest rates would take care of that. But if they keep driving it, it's going to be bad. This country needs a solid real estate industry. Not only for new homes, but second homes, fixing up things, Lowe's, Home Depot, all of that. It's incredibly important to our economy, and what they're doing is absolutely crazy. So I'm going to go to bed tonight praying that maybe one or two more go, and then the Fed steps in and said we're gonna ease it, and rest assured that we're going to do everything in our power to make sure that no other banks go under, because this could really start a devastating chain of effects. And it could also very, very much carry over into the stock market. And we could be looking at I'm not saying it's going to happen, but it could. It could trigger a chain of events. Since we have so much algorithmic trading, we don't know. There's certain levels that are baked into these algorithms on the SPX and different indexes that once they get triggered, it can set into motion all kinds of other buying, mostly selling of other instruments. And we could see something that we've never seen before. Let's just put it that way. And I sure hope that doesn't happen. So I wish I was coming with better news. Monday, we should find out a little bit more if the Fed is going to step in. But the problem is right now, the FOMC meeting is in 2 weeks. I believe it's like on the 22nd. Well, they have to go into what they call a blackout period where the FOMC members cannot make any statements due to the fact of influencing one way or another anything to do with their upcoming meeting and what they may or may not do with interest rates. However, I think they could call an emergency meeting because this bank, as I said, was a well-run bank. These people up in the Silicon Valley, Etsy isn't the only company that's been affected by this. It's the only one we heard about today, but there's hundreds, possibly even thousands of other banks, and we're talking millions of people are affected because their payroll was processed through this company. Here you've got 250,000 Etsy sellers that are depending on that. I mean, the implications of this are so wide-reaching that it's insane. So I wish I had better news. I don't like making this kind of video. Hopefully, I can be back with a better video topic in the very near future. So everybody, hang in there, and possibly talk to you next week.